Hello and thank you for joining me this Friday, the 31st of January. I'm Grady, market analyst with Bell Direct, and this is our weekly market update. This week we saw the ASX rally to another fresh record intraday high as inflation easing and corporate results boosted investor outlook and optimism for an RBA rate cut come February. Now it is the last day of January, and what better way to close out the month than with a reporting season outlook as we head into the all-important first half FY25 reporting season in Australia and FY24 full year reporting season in the US. Firstly, from a broad perspective, what are markets expecting from earnings this first half locally, and what global and local factors are expected to have impacted earnings in the first half? Well, China may be showing signs of a post-pandemic recovery now, finally, but during the first half of FY25, activity in the region remains subdued, thus extending the depreciated demand environment for any companies exposed to the region, like our iron ore giants and even winemakers like Treasury Wine Estates. The AUD has been weakening over the last few months, meaning higher input costs for those buying goods and services in USD terms. But for the companies selling goods and services in USD terms like Pro Medicus, Block Inc. and James Hardie Industries, the stronger USD over the last few months is likely to boost earnings from operations in the US. Gold soared to the moon in the first half of FY25 and even hit a fresh record high this week per ounce spot price. But this doesn't mean all gold producers will soar this reporting season. What we will be looking for when analysing the results of a gold miner is the all-in sustaining cost per ounce against average sale price per ounce. CapEx is also a key metric to decipher the leaders from the laggards in the mining sector this reporting season. With Capricorn Metals and Gold Road Resources announcing record gold production in a time where they are selling to the spot market, there's no wonder why Bell Potter's analyst has a buy rating on these gold producers. The miners have faced a tough first half amid volatility in the commodities space and uncertainty around outlook for the second half. Operating in a depreciated commodity price environment is very tough, but for those controlling costs and delivering quality output, we are seeing demand for shares rise. Pilbara Minerals delivered sales volume and average realised prices above expectations in Q2, despite a very weak lithium price, and as a result, shares rose on Wednesday. On the tech, REIT and consumer discretionary fronts, we are expecting a rebound in growth outlook from the first rate cut when that is announced. Investors preemptively bought into these sectors this week amid rising optimism of a rate cut in the very near future. Tech stocks benefit from lower interest rates in the way the higher debt levels they take on to fund growth becomes cheaper to fund with every rate cut, while REIT stocks that struggle to pass on elevated costs in a higher interest rate environment, so any rate cut eases the cost pressures faced for this sector. And of course, consumer discretionary demand and spend increases with rate cuts as consumers have greater disposable income in the lower cost of living environment. We are expecting a tougher first half for these sectors, but anticipate positive growth outlook into H2. In summary, what we are expecting this reporting season is single-digit earnings growth is expected as many of the companies that included first half guidance last year indicated tougher economic times and conditions were weighing on sales. Thus, single-digit earnings growth was alluded to and guided to conservatively across the board. A rebound in demand outlook and growth across most sectors into the latter quarter of H2 is expected as inflation eases and the RBA is expected to announce the first rate cut in Australia. Those operating in USD terms will benefit from the weaker AUD throughout the first half. Higher promotional activity to reduce inventory levels for our consumer discretionary stocks will likely deplete earnings for our retailers. And of course, we are expecting guidance for the second half, which is always reassuring to our investors this reporting season. Locally, from Monday to Thursday, the ASX 200 rose 1.01%, driven by the consumer discretionary sector gaining 3.7% amid increased demand outlook for discretionary spend, which with interest rate cuts coming into effect in Australia. Hopefully. The winning stocks were led by Emerald Resources rallying 9.81%, Karoon Energy rising 9.64% and Sigma Healthcare adding 8.15%. On the losing end, Zipco tumbled 23% this week on a trading update, while Deep Yellow fell 11.68% and Stanmore Resources ended the week down 9.03%. On the broader market index, the All Ords rose 0.99% this week as Dropsuite rocketed 30.23%, while Playside Studios tanked 44.59%. The most traded stocks by our clients this week were led by Zipco and Nickel Industries. Clients also bought into Appen and BHP, while taking profits from the big banks in NAB, CBA, Westpac, Macquarie, ANZ and APA Group. And the most traded ETFs this week were Vanguard MSCI Index International Shares ETF, BetaShares Australian Small Companies Select ETF and BetaShares Nasdaq 100 ETF. On the economic calendar front next week, we may see investors react to Australia's trade balance data out on Thursday, with the forecast of a decline in trade surplus in December. Overseas, US manufacturing PMI data for January is out on Tuesday, while it's a key week for the jobs front, with JOLTS job openings, non-farm payrolls and unemployment rate data in the US out later in the week, which will paint the picture for the Fed's rate journey after America's central bank held rates at the meeting this week. And companies releasing first half results next week include Argo Investments, BWP Trust, Region Group and Beach Energy. And that's all for today. Have a wonderful Friday, happy end of January and early February, and happy investing.